a CEO and a founder of early stage companies, how incredibly intimidating the topic of equity and comp can be. On one hand, the topic is often just hard to grasp. It's complex. It seems like it requires financial intuition that a lot of us don't have upon needing to hire someone. It's also quite a momentous and intimidating event in the course of a company because you're really starting to probably invest ahead of what you're making and what you've proven. So we are so thrilled to have you and congratulate you on probably being on the cusp of making this decision. And I want to invite up our panelists to help walk you through some of the important decisions you'll be making. So Michael from Novo, why don't you kick us off? And yes, come. Tell us a little bit about yourself.
Cool. My name is Michael Rangel. I'm the founder and CEO of Novo. It's a small business banking platform focused on just modernizing small business checking accounts. And we're doing that through offering, easy to use tools, great service for business owners on the go.
And how long ago did you launch it, Michael?
Well, we incorporated the business initially beginning of 2016. We, quote unquote, launched it into our invite-only release where we started bringing on customers about a little over a year ago.
Mm-hmm. And you have a co-founder?
Yes, one co-founder.
And how many people are on the team?
So we have around 20 people here in New York City. And then we also have a pretty interesting mix because we have about 25 abroad in India.
Okay, great. And one more question. Is this your first time founding a company?
Yes.
Okay, great. Thank you. Madan.
Oh, hi. Hi, guys. My name is Madan Nagaldini. Call me Madan. I'm the Chief People Officer for Blink Health. Of all the startups that I've done 3 right now, and then 2 that became really big companies. This is one of the most exciting times in terms of getting prescription medication to all of us at prices phenomenally affordable. We're Series B, 300 employees, closing to 300 employees, and my job is to run the people on all of it, L&D, talent acquisition, getting the exec team to work. Which is a big thing. And then prior to that,
getting the exec team to work.
Exec team to
work
hum.
Together.
Yeah, kind of work together. One of the most highly levered teams is your exec team. And if that works well, to a large extent, your culture, et cetera, start to fall in place. Prior to that, I was with Compass Real Estate Tech. Mm-hmm. When I came in when we were about 200 employees, I left about when we were 2,500. Mm-hmm. So every kind of comp model in terms of what would work and what doesn't, at least I have both battle scars and a few wins. And then prior to that, I had a chance to be an early stage employee at Facebook, employee number 5 for Facebook Asia out of Singapore, and then worked many years with Facebook in Asia, then moved to New York as heading their HR team out here. And then prior to that, at Amazon for a bunch of years, seeing that company take off at a pace that I've never seen before, and made bad mistakes of selling the stock. And then prior to that, about 10 years in the Bay Area. So that's me.
Thank you. And when did you join Blink Health?
About 8 months ago.
And how many people were there at the time?
We were about 155, and now we're about close to 300.
Thanks, Madan. Erin.
Hi there. I'm Erin Dertuzos. I'm with Jetty. We're a fintech startup that helps renters get into apartments more easily and more affordably. I've been with Jetty for coming up on a year. I joined post-Series A. We were about 35 people split between Atlanta, Hartford, and New York. Now we have doubled in size post-B and are predominantly in Atlanta and New York now. Prior to that, I was with a healthcare startup called Quartet Health, just around the corner from here. And prior to that, I spent a decade with Meetup. I joined Meetup when we were about 40 people, left when we were about 200. So went through Series D there. I've seen all sorts of comp models, bonus-based, not bonus-based, equity, re-grants, you name it. And again, some battle scars, using data that was reliable, not reliable, no data. So I'm excited to be here and share some of my experiences.
Thanks for joining us.
Thank you for having me.
Elena.
Oh, hi, I'm Alana Krieger. I am the Director of People Operations for the Bikes and Scooters Group at Lyft. And I started my people career as a compensation, benefits, and employment lawyer at a law firm, and then I was at Viacom for 8 years. And after that, I was at a series of startups, including Boxed here in New York, and we grew from about 150 employees to about 450, 500 in my tenure there. And right before I was at Lyft, I was at Via as the head of people in both locations.
And I'm sorry if you mentioned this, how large was Lyft when you joined in New York, the New York office?
So the New York office has grown tremendously. I've only been at Lyft for about a year. And when I joined, the bikes and scooters division was 80 people, and now we're over 400 people. And in New York, we were just a few dozen, and now we're a few hundred.
Mm-hmm. Okay, thank you for being with us. Michael, let's go back to you in the beginning of Novo. You and your co-founder started the company, you had the idea, you probably built something, and you hired people. So can you tell us the story of those first 1, 3, 5 people? How did you decide who to hire, and how did you decide what to pay them?
Sure. So very interesting question. Partially because we bootstrapped the business for the first 2.5 years, right? And so we bootstrapped the business from my quote, MBA fund. I was, in between going to get my MBA or launching a business. And I ended up obviously choosing this route. And with that, we were like, well, we can afford effectively one developer in New York City for about 6 months before they'll leave us and we'll go bankrupt. So we could do that. Or we got to get creative with our resources. So that's kind of what started us looking abroad. Mm-hmm. We ended up hiring about 5 people, part of our core team in India, 3 developers, 2 designers, for some pretty beneficial rates. And we really spent a lot of time out there. Mm-hmm. It was very different. It's not your normal, outsourcing gig. In the last 3.5 years, my co-founder and I have spent 6 months boots on the ground in India, building out the culture, offices, hiring people. We never went through an agency, anything like that. So it's not... I'm not sure that was the answer that you were looking for. I could kind of chime in about New York.
I do want to go there. I just want to first ask, are those original folks still with your team in India?
We've had 0 churn in India to date, which is pretty wild.
Fabulous, yeah. So tell us about the business people in New York.
Sure. So we started bringing on people in New York about a year and a half ago. Mm-hmm. When we just finished the accelerator program, the Barclays Techstars Accelerator. We, kind of proved the model. We started raising a little bit of money. We knew we needed more boots on the ground here to help myself and my co-founder. And so the first person we hired was an ops person, and then we hired a designer as well.
Okay. And how did you, in going to just talking about the ops person, how did you decide what to pay them?
Great question. There are no real easy answers here, right? Especially because we're a startup. And, I've thought a lot about this, building a team, bringing on people. It's very difficult for an early stage startup, especially a founder, right? You want to try and get the best people, but it's also very hard, especially if you're cash constrained. What I did in the early days and what I continue to do now is I look at some different publicly available resources, whether that's Glassdoor or other things that might be available like on AngelList and so on and so forth. And you kind of just put together a matrix, right? And what I give to my team are just options, mm-hmm. right? And I usually give about 3 options with a sliding scale. Right, one with cash comp, one with equity comp, because there are different scenarios, right? Different people are dealing with different things. So, you offer, more cash comp, less equity, and vice versa. And so that's kind of how I started out, and I gave people the option, and that has really resonated with a lot of people. People like kind of having that little bit of optionality in the beginning. And so that kind of in and of itself gives me a little bit of freedom to offer a wider range, mm-hmm. and then it gives them the ability to choose what fits for them. But yeah, that's how I pretty much based it on like those public resources, and then build it off from there.
And as you hired beyond the first ops person, I think you said you had a designer come in next. For the next few people, what did you learn as you went along? You had a scenario for how to hire the first person, what to offer them. What were some of the things that you started to learn in those early days?
So good question. There's not a real clear, direct answer. But I think the biggest thing that I've learned is not only as the founder CEO, right, are you kind of extending offers to people, but it's kind of mutual here, right? Like you are kind of betting on a candidate, but that candidate is also betting on you. And I think that is one of the biggest realizations that I had. Right. So, they're betting on you and the success of the business into the long term and kind of being in for the long haul. And so just like you think you are taking a risk as the employer, the person on the other side of the table is also taking a risk because it's a time trade-off as well.
Yeah.
Right. So that was one of the feelings that I definitely wanted to tap into when I was hiring. And it's all about, setting expectations of what that role is, what it could become, and allowing that person to stretch and accomplish their dreams and goals and all of that stuff. And just being very clear with what that looks like. That was definitely what I learned very early on, but then also being super clear about, it's a startup.
Yeah.
There are obviously risks involved. It can be scary at times. It's very difficult and very hard, right? That turns on a lot of people and it excites a lot of people, right? With that autonomy and having that challenge. But yeah.
Great. Thank you. Alana, to founders and Michael's who are in Michael's position now, what are some of the places they can look and how would you advise them to think about their first hire, their fifth hire when they don't necessarily have a legacy hiring structure?
You mean tactically how to find the people or how to pay them?
I'm a co-founder. I've spent my time building something. I'm working hard to market it. Maybe I'm fundraising. I don't have expertise in equity and comp. How do I decide what to offer my first hire? And for the sake of argument, let's say it's a business person on the business side, not technical. We'll get to that.
So I think what we just heard is really key, which is that what motivates people is very, very different. Everyone in this room is motivated very differently, and one of the benefits of being an early stage employee and an early stage founder is you have the flexibility in a way that as you get later stage, you're not going to have to tailor packages to what really incentivizes that person, right? So anyone who you want to hire is going to be able to be hired by, your fellow peers here in the room, right? That person you want to hire, your colleagues want to hire as well. So it's really important that the most important thing is that the role really resonates with the person. And then it's a matter of, do you have cash to hire? If not, let's talk about what we have in the form of equity, but also just talk about what really triggers them. Is it autonomy? Is it the purpose? Is it your mission from your organization? Don't discount all that you're offering at this early stage where you're not able to offer a ton of cash. Everyone knows you can go to, the Googles and the Amazons and the Facebooks and get your cash there.
Yeah.
But really, really make sure that you identify what you're able to offer as an employer.
Great, thank you. And Erin, what about talk to us about some of what you're able to offer as an employer beyond cash and equity. What are some of, and we'll say benefits, what are some of the other reasons you find that people are excited to join startups, and what are the other forms of value that they're getting, maybe even creative perks or something?
Sure, great question. So I think early on, it's very important to figure out your company's values, and those come from the top. And the longer you wait to identify what those are and what you want to bake into the culture, the harder it is later on to then try and bake those into the culture. And I'm not talking about writing a bunch of things on the wall. I'm talking about as you're interviewing candidates, as you're talking to folks about potentially joining your team, zeroing in on the things that you hold important and true. And these things take time. In my last role, I actually uncovered a personal value of my own that I knew I had all along, but I realized that it was something I would die on a hill over. And it took that role for me to figure it out because I wasn't aligned with our CEO on it. But I think that's very important. And that motivates a lot of people in startups because so many startups are values-based and do pay more attention. And you see that because now huge companies are talking about their mission statements and spending millions of dollars in creative, trying to come up with mission statements and values to attract the talent that they can't get otherwise. So I think really spending the time to think through why you're there, how you're going to behave toward each other early on, pays back in spades as you grow. For example, Jetty had their main office in New York, very values-based from day one. We had an office in Atlanta that operated completely independently. They were on a different payroll schedule. Just everything about them was independent. And when I joined, I said to our co-founders, one of the first things we're going to do is figure out if Jetty South is going to feel like Jetty in New York. I don't even care what the answer is, but the fact that we don't have an answer right now is problematic because Jetty South is creating its own culture. And at some point, you're going to want an answer to that question. And it's going to create a lot of thrash and heartburn when we decide yes or no, it needs to feel like New York. So I spent my first 3 months pretty much commuting from Atlanta, trying to build out that culture. So the longer you wait, the harder it is. The other thing that I would say when hiring your first few employees that's often overlooked is checking references and the value of checking references. When it's just you and your co-founder or just you and you're working out of a co-working space and everything's super scrappy, I've seen many founders just go with their gut and move forward with the hire and not think through the reference checking thing. And then as the company builds, that first, second, third employee is bringing on more and more people, and it's becoming clearer and clearer sometimes that they're not the right fit, and it becomes harder and harder then to part ways. At some point, they have a big stake in the company. They've helped recruit half of your team, and the cost to potentially parting ways is much higher. So your due diligence there, few phone calls, few emails is so worth it and pays back in spades. So those are a couple things that I would say are really important.
Thanks. Madan, I'd love to get your perspective too on the value that a startup can offer a potential hire that might be outside of the traditional buckets. Aaron mentioned values. Are there other things that you have found that have been attractive to early stage hires?
Yes, I think early stage hire, you at least those people that have come across, double click on the founder, like what's the mission and how does it look like? The people would love to look at what the outcome and the upside is. If you're not selling the upside, it doesn't matter how much you talk about what the mission is. You need to have a perspective of what's your total addressable market, what's your product going to do today, in a few months from now, and how quickly you will get what percentage of the market, and then you're like, hey, we're seed, I think we're valued at 10 million, but look at the market, we're going after a $30 billion market, and even if we capture 0.5% of this company is going to be worth $100 million. If you don't speak in specific numbers, at least I have found, your best employees will not join you. Yeah. So I think telling the story financially is very, very important. So you have to, the questions that really good employees would ask would be to say, and I think somebody on the panel brought up saying, what is the re-grant? Is it just a one-time grant? I mean, if I'm going to get promoted, how do you think about it? How much have you set aside for the employee equity pool? And the most important thing that I think this crowd here would really love is when you raise your next round, will you go back to your investor and say, hey, I want to give a secondary to people who already been here for the last 1 year. If you don't have that conversation, your best employees will walk up to you and say, I'm done. It's very important to have a strategy around what your secondary offering is. So you have to go back to your investor. And I kind of like to advise my CEOs saying, you should allow people to sell about 10 to 15% of their vested equity at a price that is lower than what your investor is paying, but not too low. So let's say your share price at the next round is $50. Your secondary can be about 35 or 15-20% discount, and you have the right but not the obligation to sell it. So if you think the company is going to do really well, you're not going to sell it, but that gives a lot of liquidity options for people.
At what phase have you seen startups grant the option to sell in the secondary markets? on behalf of allow their employees to sell in the secondary market. That seems to me, in my experience, a later stage problem.
Thank you for clarifying. I didn't mean secondary market. It was going to be hard for you to manage the cap table when you have so many new people who bought your shares.
Yeah.
I would rather ask the investor coming in to say that I want to offer a secondary sale to my employees, and they sell it back to the investor.
As part of the agreement.
As part of the agreement that they would come in.
And so, at what stage do you think this is something founders should? I mean, this is something that founders should consider as well for their own motivation.
If your round is oversubscribed, you have to do this. If I was an employee, your round was oversubscribed, and you didn't do this, I would be like, "What kind of a CEO are you? You didn't give me the option when your round is oversubscribed." Mm-hmm. But your round is not oversubscribed, then it's going to be harder to do that.
I want to step back just to make sure everyone's clear on what we're talking about, and that I am also clear. When you grant equity or you grant options to people, at some point you might make it possible for them to sell those options, which is not something that's actually often discussed, I think, as much as it should be for early stage founders in particular. A lot of founders are also coming at this with very few resources in their bank account, and if they're going to be in this game for the long haul and going for liquidity that is in line with probably what their venture investors are going to want, they might need, $500,000 something to kind of get them through the next 5-10 years to really get to the place where it's interesting for everyone to sell. Otherwise, their risk tolerance is probably very different. And the point that you're making is that shouldn't be just a founder thing. Yep. I'm sorry, I'm just going to ask this again. So at what stage should this be offered to, it's not oversubscribed, is this a typical thing for a founder to be promising or prioritizing before a Series C, let's say?
Right. It is not a typical thing.
Okay.
But the companies that have done it, for example, Compass offered it. It's public. I can share that. I think for 2 rounds or 3 rounds, employees were so happy that they then told their friends, this is a great place to be. And it was easier for me or my recruiting team to hire. There are not too many companies to do it. Facebook, I think, did it as well. So I think probably Facebook did it on a different route. But from A to B, B to C, you can always kind of park, 15% of your vested options. If you do the math, it's not too much. People could walk away with probably 30, 50K.
Yeah.
That's a welcome relief in a cash. If you're especially coming in from a publicly traded company where you've been used to having equity vest every quarter, and then you come into a company that might not see a liquidity event for many years, this really helps keep employees for the long term.
To jump in here, I spent 10 years with Meetup. In my last year, I was forced to decide whether or not I was going to buy my initial grant because of IRS regulations. And many, many employees were faced with that in our time at Meetup.
Because of what?
The IRS regulations. Okay. So essentially 10 years from the grant date, you essentially have to purchase your options or they disappear. And to put that burden on employees while they're working to have to decide whether or not to put that cash outlay was really unfair. And looking back, that was one of our cardinal mistakes, and our co-founders and I talked about it many times once I left, that we essentially never offered a liquidity event to any of our employees until the acquisition by WeWork. And that meant that no one ever was able to cash out their grants. And we gave re-grants very regularly. I think I got 6 or 7 re-grants in my time there, which worked out well when we got acquired. But most people, when they left, did not access their equity because they saw no point in it. It had no value to them, and especially if they'd been there a while.
Can you just define a re-grant again?
Sure. So re-grant is essentially a second grant once you've joined. So if I've been here a year or 2 years, whatever the company has deemed as adequate, or you've been promoted or something, it's an equity grant secondary to your first grant when you've joined as a new employee.
Michael.
Yeah, so I wanted to add to that. For all of the earlier stage founders in here, seed, Series A, what have you, obviously I'm a little bit earlier stage than the others on the panel, but that is a serious red flag if you're talking about secondaries for investors in that early of a stage. So I'd be very cautious of that. If they're already hearing from the founders that some people want liquidity at that early stage, they already are in the back of their mind saying to themselves, like, these guys aren't in it for the long haul. They're just trying to make a quick buck. So I'd be very careful about that. I totally support like longer term, like you definitely want to allow, for liquidity for your team or, different life circumstances present themselves, and it becomes way more realistic when you're approaching, B plus. But definitely earlier than that, I'd be very careful.
That's great advice. Can somebody just give me the definitions, like when you're Michael, actually, can you explain this? You make your first hire, the first hire to whom you grant equity. How did you set up the corporate structure, which is kind of legally? And then how did you kind of portion off what amount of the value of the company would be for the hires?
Sure. So there are a few things at play. Like sometimes startups will just do it on the back of a napkin, right? And kind of just have that verbal agreement between whatever yourself and your co-founders or early employees or what have you. Really, when the option pools is what they're called, when those become formalized, is at like the first round of financing, right? When you have VCs come in and then everyone apportions the amount of equity they want allocated to the option pool, and that's typically how it works.
And are you set up as an S corp or?
So I mean, we're set up as a C corp.
Okay.
That's pretty standard for the most part for venture-backed companies.
And if I'm not mistaken, would it be correct to advise people in the audience, if you're planning to be offering equity pretty regularly in your early days, to set up as a C corp?
Yeah, but it's easiest, right? Because there are templated agreements out there that you could literally find pretty easily online. When you're starting dabbling into other, newer corporation types, like it gets more confusing. So the legal bills are higher. So.
And when you offer equity, are you carving from a pool you've set aside you mentioned the option pool. So you designated this pool early on, or did you employee by employee decide how much of the entire company to?
So it's kind of the reverse, right? So early on, it's definitely employee by employee. Basically, what we did back then was you have this number in your head of what the company's worth at that time. So you're trying to say, okay, let me attribute, let's say, $10K worth of options, and I'll offer that as part of the package, right? So that's basically, back of the napkin once again, and saying like, hey, this was our last valuation, whether it was, from a previous investor that wrote a check or what have you. And you say, this is based upon the last valuation, this is where this is worth. And obviously we're expecting it to grow. And then,
Alana, how do I know, how much equity should I offer someone in the early days? How do I decide how much equity to offer?
For that really early stage, it's actually probably a question for the folks who've really set up their entity and hired their first few employees. But I think ultimately what you're doing is you start with the whole pie, and it's a matter of what value people are adding, what their ownership stake is, what the risk is that they're taking, when they're coming in. Once you start with your seed stage and Series A, you end up with a finite equity pool, because then you have other investors who've bought in and they have equity. And so let's say that pool is 10%. You're going to want to look at that pool and say, okay, I've got time between now and the next raise. And here's my trajectory. Here are the number of people I have to hire. Here's what their levels are. And really back of the envelope, figure out tops down what you can offer people when it comes to equity. One thing that some early stage companies do and get themselves in trouble is they do bottoms up. So for each employee, even though you have a limited pool, you're still thinking, what is this person worth? What is that person worth? And as people negotiate, you're offering equity that seems fair and reasonable, but it's finite. And if you run out of it before your next raise, the position you're in is either as founders, you might be putting your own equity back into that pool. You might go back to your investors and ask them to put equity into the pool. They love that. So just know that in order to show that you're really planning, start from sort of tops down and get yourself from now until your next fundraise.
Yeah, Madan. Yeah.
I like to think of that as what is the actual percentage? Like, for example, if you have a CTO, head of marketing who's focused on customer acquisition, head of product, and then legal and HR, et cetera, just having, to your point, having this clear point of view on should I give this person 2%, 3%, 1.5%? What does it actually mean? I mean, if you don't have that number, then you will go based on, if you're desperate for talent, you find someone really good, you might over-index and pay the person 3%, which then will start to appear a lot as you kind of start to, as the company grows. I think, best practice is not just on what is the actual percentage you want to give based on value and based on, but also do you want to give, what's the way in which it will vest? Mm-hmm. Is it a straight line vesting? What is the cliff? Will it vest after 1 year? Is it 4 different years of 4 cliffs? Is it first cliff and then vest quarterly thereafter, monthly thereafter? Mm-hmm. And then are these options or are these RSUs? Huge difference, massive.
RSU.
Yeah, restricted stock units, or are they stock options? So the stock options, I mean, it's a whole technicality in how you kind of set up your system. Mm-hmm. If you have options, in most option programs are written in such a way that when an employee leaves, the employee has 90 days to buy it back from the company. The options has a strike price, that is, and it has a preferred price. The preferred price is the price that investors are willing to pay. The strike price, there are different ways you can think about strike price. The Black-Scholes model is one such many options, so that's more or less like your actual value. If you're an enterprise based on and which your accountant or your or your third party auditor would certify, and the gap between the strike price and the preferred price is also very important. Mm-hmm. And then if sophisticated senior employees will negotiate that if you were to fire me, what happens? Yeah. If I were to leave, what happens to my equity? Can I buy it back or not? I think you made a great point saying, if it is RSUs, you don't need to buy it back because it lasts for 10 years. But if it's options, you have to. Then if you're giving RSUs, you give less RSUs than options. So you just have to go through that, and you need some help to understand that. To your point, Series C to Series A, there are 10 people, you can manage that. Yeah. But calling someone, in HR. But the moment you go from Series A to B, it starts, I think you made a great point, multiple different employees showing up, et cetera. But all these technicalities are very important to understand.
How should the founders split equity among them? And Madan, can you answer that? Do you have advice, having seen a number of founder teams, how when you're kind of ready to start hiring, where should you be in terms of equity breakdown among founders?
I mean, if both the founders are very technical, mm-hmm. then I would say it usually ends up as kind of half and half. But if one of the founders is more technical and the other person is more business-like, I kind of like to index more on giving equity on the technical side. And that's because you're going to be attracting a lot of engineers who will double-click on what is your equity, what's the equity plan. I think so. It also depends on if you are a founder looking for a co-founder. Of course, it's not going to be the same. You will have much more of the company than the co-founder. But the key is going to be, is the other person who you are pretty much your work husband or wife, right? Every day you come in and you're going to work with this person shoulder to shoulder. Is that person engaged? And does the equity that person has kind of get that person, getting up from bed and coming to work? Because most of the comp you will take or your base salary is going to be limited because you will want to conserve cash. You wouldn't want to kind of go beyond. I like to have this as $100K when you first start. Series A, you kind of get to $200K and cap it off at $300K at Series C and after as a founder. So that's how I would like to look at it.
I'm pretty interested in what you just said about maybe technical founders should get more than the business founders. You're nodding, Aaron. Is that something you think is important?
Yeah, that's something I've seen as well. I've seen, and again, these things are so intimate. It really, even when looking at comp data, I always tell my founders, like compensation data that when you're a little bit larger, Series B, C, and so on, you can purchase compensation data to kind of look at where the market is at. My advice to founders who want to see data on equity, I always tell them, like, you can buy it, but it's such a unique thing that I don't think it's actually worth purchasing because it's so intimate. But yes, I agree that I've seen technical co-founders have a little bit heavier equity because of the lift in terms, if it's a technical product, because of the lift in terms of attracting technical talent, the dependency on it being a strong product. On the flip side, I've seen if it's, if the reliance on the business partner is driving sales, I've seen higher cash comp on that side or a variable to balance that out. So all in, like the cash values equal when you figure out the equity. But yes, I've seen that.
Are both of you saying that people who are hired after the founding team will get transparency into how much the founders own? Or are you saying that it's about the incentive? Because it's about, having...
Yeah, it's about the incentives. I wouldn't want to kind of tell the newer employees what the founders own. But I think going back to your previous question, you made a really good point. If you look at your technical co-founder, more or less, most likely he or she is very accomplished. That's why you made her or him your co-founder. By default, you have to assume that this person is going to walk into a job like a director of engineering at Facebook or Google or Amazon. Entry-level director in engineering Facebook salary is $850K.
Yeah.
Right? $400K in cash and $400K investing equity every year. So if you don't have your co-founder excited about the fact that the value of the equity he or she is having is at least 3x or 4x more than that, they would walk in. And if your co-founder can get a job in Google, the entry-level comp is almost $1.1 million there for director of engineering comp.
Yeah.
And the same thing in Amazon might be slightly less, but you're looking at a range of between $600K to $1.3 million is the value of a technical co-founder if you think the person is really good and can make it into these companies. And so you got to kind of work backward from that.
Sure. Michael, please, how did you and your co-founder think of this? And tell, was it awkward? What was the conversation like?
Yeah, sure. So it is awkward. It's pretty awkward. I'm not going to lie to you, right? But at the same time, what I really want to reiterate here, guys, is that the way that you should think about these splits between co-founders, it's all about setting expectations. It's like, who do you want this person who you're going to be, like he said, your work husband or wife for, in theory, many, many, many years to come? How do you want to set the scene for them? Right? Meaning, do you want to take 70% of the company and you want them to have 30? Is that going to motivate them, right, in the long term? Or is it going to be something to the effect of like, listen, we should be equal because we're both putting in our hearts and souls to what we're building, right, over time. And we're going to figure it out as time goes on because we're both taking risk. We're both not taking the Googles, or Facebook jobs and the big paychecks, right? So like myself and my co-founder, when we set out, about 4 years ago now, and had these talks, it was pretty awkward. I'm the business guy. We did split the business 50-50. I'm not sure if I hoodwinked him or if it just, worked out that way. But we have a really great relationship because we are literally like the closest founders I've really come across. We've lived with each other for the last 3.5 years. So like we work and live with each other, go on vacations together. And that's something that's also very like intertwined, like with our culture too, which is really cool. And that you can see it in the office as well, with everyone else's relationships. We aren't super explicit about like, I have half, you have half type thing, but like everyone kind of gets that just because of how we carry ourselves around the office.
Thank you. And please tell us how what do you advise early stage founders in the position that you and your co-founder were in about how much to pay your first hire in equity? How did you, if you can, share as many specifics as you feel comfortable sharing, but what should they get? What should the CTO get?
Sure. So my co-founder is my CTO, so that's a little bit of a cheat I just issued there. But for the other early employees, what I do is basically just look at public market data, whether that's Glassdoor, and see what the public markets are paying for those roles. And then obviously you as a startup, circling all the way back to the beginning of this panel, right? You have a lot of stuff to offer as well. You are offering autonomy. You're offering, the ability to create a career and like create an impact in the world, all of this stuff you're offering to someone. And that's, why a lot of these people even want to entertain the idea of working for a startup, right? So there is a lot of value associated. It's very intangible, but there's a lot of value associated with that. And so with that as a backdrop, so you look at what's available in the public markets, what, other public companies are paying, in your industry. And if you have cash, you want to try and be around that level, maybe a little bit discounted to that. And obviously the other person on the other side of the table should understand. And then what I have done is just make up the difference in equity.
Mm-hmm. And you said that you give people sliding scale opportunities. Is it a signal to you or a flag if someone opts for a low equity share?
Yeah, listen, I thought that in the beginning. But you know what? Everyone has a different, they have different things to deal with. You don't know what people have to deal with in life, whether it's family, friends, work, you never really know. Mm-hmm. So all of our, scales include equity. Obviously it's sliding. But, in the early days, I did have that concern, but I wouldn't say I have it really anymore.
All the people who are not on your full-time day-to-day team, maybe advisors specifically, how do you compensate them?
Great question. And if you guys don't know about this resource, it's the go-to that I've used the entire time. It's called Founders Institute. I think it's called the FAST agreement, which they've literally standardized all advisory agreements, and they've been very, very clear and articulated the different tiers of advisors, their contribution by time, strategy, all of this stuff. And it breaks it down even into equity ranges as well. So that's very helpful. It tells you for an early stage startup versus a growth stage startup, and it kind of maps everything out. I think so. That's super, super duper helpful. And then getting back to what you said earlier about Cliff's investing, that's another thing that you definitely want to be very keen on. Mm-hmm. So with that said, though, you definitely want to be sparing with advisors, at least from our experience. Advisors are a quick win for the most part is how you should look at it. They're there to help you getting into their networks or answering questions that you might have. And you just want that vesting schedule to kind of be your defense mechanism, right? So if, someone signs the agreement and then just disappears off into the sunset, obviously that can be clawed back.
It sounds like you probably should be clear about what your expectations are then.
Yeah, absolutely.
Advisors. What about, we're getting some questions about people who do not work full-time at the company who are maybe employees, maybe part-time employees. Should these people be getting equity? And anyone feel free to jump in. The specific question is, a CTO type providing 10 hours a week in unpaid sweat equity. Early stage then, should they be getting equity?
I mean, I'll just answer that. It's what they've said, right? It's all super intimate. There is no real answer for it, right? It's really what you feel in your gut. Is that person providing real value, mm-hmm. right? Number two, do you want to retain, or do you think that you could retain that person into the long term, right? Because if that's the case, then there's a very different negotiation than, all right, we need to use this person for the next 4 months to build a prototype to then bring something to market, and then we can raise a little bit of money and then get a real person, right? But once again, you always have to use this ammunition as, setting the expectations and how do I get the most value out of, whatever relationship it is. For me personally, if you wanted to retain that person long term, I would incentivize them with equity. If you have doubts about retaining that person long term, I probably wouldn't offer them equity.
But often isn't the question, I don't have enough money, but I need to get this product built?
Sure. And that's, what every startup has to deal with in the early days, right? But once again, this is where the founders have to be salespeople to a certain extent, right? You're getting into relationships with your early employees, and it's, painting a picture of the world of listen, this is where we are now. This is where we're going to go. And this is your contribution to that. Mm-hmm. And you have to really leverage that as a huge, point of motivation.
Alana, when we talk about equity and kind of the incentive to that feels like kind of a baked in mechanism to let people know they'll grow with a company and be rewarded as things improve. Are there ways that you can talk to early stage hires or even later, about growth potential? How concrete can you be about growth potential, whether it's in terms of wealth or career in those early stage hiring meetings?
Yeah, and I think some of the panelists have said this as well, but that's everything. Right? Someone's joining your team in the early stages, employee number 5 or 10, because of the growth potential. It's both the growth as an individual. So as we noted, they can go and work at Facebook or Google for 7 figures, but they're choosing, right? You want to hire those people who could go and work at the Facebooks and the Googles, and you want to find someone who's choosing to work with you because of what they can create. Like that person who just gets passionate about starting at the ground floor and creating something almost from scratch. So your biggest lever is your story. That same story you're telling to your peers and to your investors, that same story goes to your potential employees. So talk about the growth and what you see from their own individual career perspective. I don't want to sell it too much, right? One of the things that sometimes people really get caught up on is over-titling. For example, your first lawyer is your general counsel, and that first finance person is your CFO, and it really ties your hands as you grow. But the idea is you're running finance, you're running legal, and sort of the sky's the limit. It's a great opportunity, and also the growth potential of the organization. What's your story? What is the future? Not sort of what's this crazy year going to be, but what's the 5-year, 10-year vision?
And do you speak specifically to people about they can become CFO, or I think this probably applies to whatever stage someone is, the company is, but that they can become CEO, or that it will raise another round and then you'll be paid more in the salary portion of your comp. Can you be specific? Can one be specific in these conversations, or is that not relevant? Or is that not necessary?
I just don't know that it gives that there's any value to that. It's really like what is today? What is the next year? What are we going to do? What are we going to be building together? And it's the ownership and the autonomy. If someone's really motivated by the extra salary we're going to get at the next raise, or that title that I'm not giving you now, but I'm going to give you in a couple of years, I don't know that you're getting to the right place ultimately.
Okay, sure.
I've seen for folks who are taking significant cuts, where we are in the process of fundraising to close them, saying, and when we close the next series, this is the bonus if you're meeting expectations that you can expect. I've seen that in a couple instances. Now, I work in an industry where we are hiring people out of insurance, where at director level, they're making $400,000, $500K with bonuses, and they're taking more than a 50% cut. So to try and make them whole, at the time we were fundraising, we did that for a couple people. I essentially would liken it to like a sign-on bonus almost, because it was a few months out. Titling, though, has been probably one of the bigger nightmares that I've dealt with in early stage startups that I have had to clean up when a people team or a people function has started. So there's a lot of very junior folks who are attracted to startups because it's a very quick trajectory. You learn on the job, you have autonomy, impact is huge. Then the team starts scaling and you have to start layering sometimes. And then you've got a director of something who has 2.5 years of experience. And then you want to bring in someone who actually is a director level, who's got 12 years of experience and is that's not going to work. So one of the first things I did at Jetty was we looked at titling, and that was very painful. There were a lot of tears, not from me. from other folks. And it is very hard to take away. It is very, very hard to take away. And at a certain point with one person on the team, my co-founders just decided not to fight the fight because it wasn't worth it. So we have a couple people at the organization who are just very overtitled. And we just decided it wasn't worth the thrash it was going to create. So I've seen startups just not do the title thing because it's just not worth the heartburn as you're still figuring out what kind of functions you need, what leaders you need. At a certain point, people are going to want titles because they want to be able to have folks on the outside identify who they are and what they do. And if anything, I would try and avoid inflated titles at all costs and determine very early on what leadership means at your org and codify it and get it on paper because at some point you're going to want to. And it's like the culture thing I was talking about earlier in Atlanta. Trying to make those changes once it's set in is really painful, and you'll likely lose people over it, and good people, just because it was an oversight early on.
Yeah, that's a great insight. And there are a couple of questions that are coming in from the audience about salary for founders. And I know that's pretty important given the audience. So I do want to get to that. How do you decide how much to pay yourself when you're early, Michael?
You guys are asking a bunch of easy questions tonight. Once again, though, there's no answer. There's literally no answer. Myself and my co-founder, we didn't pay ourselves for the first 2.5 years. We were literally bootstrapping, literally off of my savings, his savings, sleeping on couches in garages, everything just to kind of scrape by while paying our resources in India. We started paying ourselves for the first time, I think about 1.5 years ago-ish. And it was literally just so we can pay bills. And then once we raised our round of capital, then our investors were like, all right, you guys should probably pay yourselves like normal human beings. So that's when we kind of upped it to more market rates.
Let's talk about that it's when money comes in and how much. I know I do advise a few companies who have actually come to me, and there are other advisors with this question, which is how much can we ask our investors to take in salary, because it is something they're ultimately kind of approving, how much the founders can take. And so what is a reasonable amount? Because I've heard them be incredibly low. I mean, often for people very experienced, getting $60K, but having a lot of the equity. I mean, anyone jump in. What are your thoughts on what they can ask for?
I think Michael said it right. When you're starting seed, you're going to be scraping the bottom. There's really no number. The framework I have advised both my founders and also the ones that I sit on the boards for, at Series A, you want to be at 100K. Series B, you want to get yourself to 200 and cap it off. You get to Series C and D, and you kind of, you're still have a long way to go IPO, probably 300K. Mm-hmm. I don't like to see founders beyond 300K because you have a significant chunk of equity. The good framework to think about is that A, you can go back to your investors and say, look, I was scraping the bottom, sleeping on couches. I think we need to pay ourselves 100K. And if your investor is going to say no, I would be careful about going with such an investor. And then I think at Series B, you earned the right. You've got people knocking on your door for Series B. That means you've shown growth. Yeah. You've shown, whatever metrics of success, and you should give yourself 200K. And especially if you are, you have kids and family and all of that, that becomes very important.
Yeah. Thank you.
I was just going to say those are numbers that I would be very comfortable with and align with what I've seen.
Alana, when you came into Lyft, in any of the companies that you've worked for, when you look back at how the founders or executives have set up equity and comp, and I think Erin was addressing this a little bit in her own experience, what are some of the things that you wish they had done differently? What are the big mistakes you saw that they made that you wish you could have gone back and corrected?
Yeah, so that's a really tricky question because I think people, at least in the companies where I've been, people made decisions that they needed to make at the time. I've never worked at some place where I looked back and said, gosh, with the information you knew then, you just made irrational decisions. So, it's really easy to go in and start as the head of HR with 150 people and say, gosh, this is a mess. But I would say that for folks at the early stage, as long as you're making reasoned, rational decisions, it's sort of the best you can do at this point. Some things that start getting ugly as you start building teams, that someone who would come in and maybe need to ameliorate, are things around internal inconsistencies, right? If you start hiring one person and one person without thinking holistically about sort of classes of people, you can wind up with yucky results that you didn't mean to have. If you let people negotiate on the front end, there are some people who, statistically based on cultural background or gender, are going to be more likely to negotiate than others. And you can wind up with an organization where you're actually just paying people differently, and you didn't mean to. You just made one single decision each time. We also talked about the titling, which becomes really problematic.
What you were talking about just now, you're kind of, some people refer to this as bands. Mm-hmm. And so at what stage should you start thinking about bands? I guess if I'm a founder and I'm just starting to hire, I might have a vision for 5 to 10 people, but I don't think I'll know what I'll be in 3 years with 40 to 60 people.
So actually putting in place even sort of back of the envelope kind of bands can only happen once you have some critical mass at a level. Mm-hmm. So if you're hiring 10 software engineers all at about the same level, you can actually, even if you only have 12 employees, you can actually start trying to just create, what does that band look like? How do I want to pay my software engineers? So you can do it little by little as you're building an organization. If you have an head of HR pop in at 150 people, that's one of the first things they'll do. But you can do it sort of little by little as you're growing. But it doesn't. There's no reason at an early stage that you want to be so dogmatic about it. Also because of the things that we talked about, like you do have the flexibility to know each individual and what motivates them and who's more cash sensitive and who's more equity sensitive.
To just touch really quickly on banding, to give a very specific example, we're doing it right now. We're at 80 people. And we're doing bands right now, not for our current people, but for hiring moving forward to make it easier. Mm-hmm. So I just finished market compensation data analysis for the internal team. To be more specific with what Ilana said, women and people of color are the people who tend to negotiate less, and that inequity builds over time. Each 10% raise on a lower salary over time grows and grows and grows. So it's not necessarily anything you did. You may have made the same offer to, say, a white man and a black woman, but one negotiated harder than the other, and boom, before you knew it, you had inequity. So I think like when you're making offers, when people are coming in, just looking at who their peers might be at the company and just gut checking is really great. And then, like I said, we're 75 going to 80 right now, and we're doing bands for the first time. One of the other things that, again, great intentions, but took some unwinding was once folks started hitting like their 1 year or 2 year anniversary and were just rock stars, they started asking for raises, which is reasonable. They were doing, 2 people's jobs and growing and, working long hours. And our co-founders wanted to reward them and just picked a number that felt generous, which meant that people got very generous raises. And generally, the only people who got raises were the people who asked for raises, which meant that now we've got some folks who are way above market. And then the only people who are getting rewarded are the people who ask, which also you've got inequity based on gender and race. So that was part of why we did the market analysis, was to correct for that. So thinking when people start asking for raises, once you get to that, starting to have people with tenure, or as you raise money, folks will ask for a raise.
Yeah.
Thinking thoughtfully of not just giving the squeaky wheels what they're asking for, but thinking holistically about that is important.
So how do you look at the shares when you're basically getting someone's advice about how to even launch the company? Should you be promising anything? At what point should you? Michael, can you?
Sure. So there's no real science there. Once again, right? It's very difficult. What you should do, what we did in the earlier days, is you look at what's market. Right. So we went through an accelerator. Typically, when you go through an accelerator, market is, people who graduate from an accelerator, you're looking at around a $6 to $8 million valuation. So because we got it after the accelerator and we were a little bit more advanced than typical accelerator companies, we went with something that had a little bit of a premium to that. And that's just where we started. Right. So that's how we kind of pegged it. So just for easy math, right? You say, okay, my company's worth $10 million. So if I want to give, 50 basis points to somebody, that's worth 50 grand or whatever it is. And like you use that as kind of that negotiating lever.
So let's say you have an advisor, first questions, CTO kind of work, doing about 10 hours of work a week. The way I kind of think about this would be, okay, that person I would pay about $500 an hour if I were to consult. That translates to $60,000 a year. If you do 10 hours a week, $500 an hour, $5,000 a month, 12 times, $60,000. And that would be, to your point, and if your company is valued, let's say at $10 million, then you would be like, okay, probably I can give that person 0.5% or 0.5 or 0.6%. I think I would do that. I would use $500 as a rule of thumb. If you don't have anything right now, I mean, that would be a good way to say. And then someone very, very technical, let's say you're you're getting advice from a chief security officer on data privacy. I mean, that's going to be twice that rate. So think about it that if you got a consulting person, how much would you pay? And then convert that in terms of, I think, what you just said right now.
Yeah, Michael.
I just want to add one more thing on what the question that you asked before of like what you could correct. One tactical thing that I'll help you guys with. So when you fundraise, right, you are prescribed evaluation. If you are thinking that you're a high growth startup, you're going to go out for venture funding. I just saw the term 409A up there. It's very, 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 very valuable for you as the founder to get a 409A valuation prior to fundraising. You want to use that as an incentive for your employees, i.e. getting them the cheapest possible exercise price. And so you're only able to do that.
If you have an idea, call up a 409A agency and ask them to value it.
Serious negotiation.
Yeah.
It's honestly, you get your evaluation and then you negotiate it.
The 409A.
I think we should talk about early exercise. Very, very important if you offer your employees early exercise. What early exercise basically means, I think you made a great point. Let's say your 409A, your value is 50 cents per share or $1 per share, and someone got 20,000 shares. They can early exercise it by paying you $20,000. And then as far as they meet the IRS requirement of 1 year and 2 years, anything is long-term capital gains. Your sophisticated engineering employees will ask for early exercise in your stock option documents, which actually is some money back to you because the early exercise rule is that they have to vest, but they pay you in advance, especially when your shares are worth in the cents or like say 20 cents, 30 cents, 50 cents, and you give someone 100,000 shares. That means for 50,000 shares, they can $50,000. They can buy the entire thing, but it vests based on your vesting schedule. But the beauty of early exercise is if your company takes off, it's all long-term capital gains. Your employees will tell 20 other people that early exercise is possible.
409A is definitely available to employees and founders, correct? Or is that private?
So 409A valuation is just like you were to get like a third party.
Yes.
So you prescribe a valuation to the company.
And is this something you typically share with the whole company?
Companies have very different practices when it comes to 409A valuation and preferred share price. The easiest back of the envelope. So we talked about different kinds of equity that you could receive. Typically in an early stage, you would receive stock options and then it would change to restricted stock units. And even later at the time of IPO, the restricted stock units would change from being valued in number of shares to currency. But in that early stage where you're giving stock options, employees want to know, okay, what are these things worth, right? I say to you, okay, you have 1,000 options in my fancy seltzer company. You say, all right, well, what is that worth? And different companies have very different philosophies as to whether or not they share what 1,000
like what
options.
the denominator is even.
Well, it really is it really is just options. So in order to value that, if you know the preferred share price, you at least know, okay, what would an investor pay for this, right? So then you get part of the value. But you really need to know, if it's options, what that second part is. Okay, like, what am I paying for those in order to exercise them? And that number is based on the 409A valuation. So in order to buy my 1,000 options, my 409A value, which is also the strike price, is, $300.
Yeah.
And so maybe that delta 700 is, or, maybe that's about what your valuation is. But it's different companies have very different philosophies.
Michael, what is your philosophy on this transparency of data? Yeah.
Yeah, that's it. So it's just all about transparency.
Okay.
So, if anyone has the questions, we readily share the prices, the 409A pricing versus the preferred pricing, all of that stuff.
I think you make a great point. You have to double click on being transparent. So what I've done is a simple template. I have something called as an offer calculator that I give every new employee. I gave you 10,000 shares. This is the strike. This is the preferred. And at various different, multiples of the company, this is the value of your equity. This is your base salary. This is your bonus, if you have one. Your total comp is so and so. So the company that did this was Amazon back in 1999, and they do it even today. It's scaled for 600,000 employees, and our accept rates at Compass went up from whatever it was by about 60%. It went up by 60% after we rolled out the offer calculator. And when I'm now at Blink, if you get an offer at Blink, you will actually get a spreadsheet that you can model the value of your equity. If you do that, it really signals to your employees that you're open, transparent, the preferred price, the strike, these are options, the vesting.
Yeah.
Of course, you got to get legal to write all the caveats saying it could go to zero as well. You don't want to be held accountable to that. But once you do that, employees understand, saying, wow, this is pretty nice. So I would highly encourage you to build a simple offer calculator and have that as a part of your offer process and send it out.
I absolutely agree. I've worked in companies that were completely transparent down to letting employees know when we'd expanded the pool that employees could own, and how hard a fight that was with our investors, but it meant that much to our CEO, to companies that were reticent to even let me know what our outstanding shares were. And that spoke a lot to the culture. And our acceptance rate was in the gutter because we didn't pay that well, and folks had no visibility into what their equity actually was worth. So it was all downside from their perspective, lower salaries, low risk or high risk. And they knew immediately that leadership was not going to be transparent about anything. Where I work now, we have a very similar setup so that folks can actually, candidates enjoy it, because especially technical candidates, because they can play around with it and see the potential upside. I'm afraid of how much upside they play around with potentially, but it empowers them to see what that equity could really grow to. And we also have done, if someone counters, where we'll give them a couple options if they want higher equity or if they want higher cash. I too, in my early days in startups, used to look at some folks like, oh, you want less equity? Like how interested are you?
Yeah.
But as I've matured over the years, I recognize that people have spouses with medical conditions. People have children with special needs. And those are things that they are not going to share during the interview process. And frankly, is none of my damn business. It's none of anyone's business. So really, I trust in our interview processes, and I let folks make their own financial decisions.
I want to go to one of the questions on the screen about founders pulling their weight. So as time goes by and things change, have you been through an experience with this where a founder leaves the company, and how is their kind of equity reassessed, or is it? Michael?
So this is another exciting topic to talk about. So
You're pretty dug in. If you guys have a problem, one of you is out on the street.
So in. It's crazy. Well, when you incorporate the business, right, when you're doing all this stuff, my co-founder and I, we literally sat around and laughed because we were signing these agreements that locked us up for everything as founders. It's like, if you screw up, like there's so many ways, right, that they kind of like make sure they ensure that you're in it for the long haul. So for that, version that you're not, right, that's why you have those cliffs. Or for funding rounds, for instance, like a lot of, different investors will maybe want to dial back the vesting schedule. Okay. Right. So like they'll be like, hey, listen, we understand you were at 3 years vested, but this is your first round of funding. And so we're going to dial that back. And now you're only a quarter vested. Mm-hmm. Right. Because we want you to stay right into the long term. In
your initial founding documents, do you have a vesting schedule?
Yeah.
Typically. Okay.
Vesting schedule should in theory be the same just across the company.
Okay. But even when it's just the two of you and it's just, okay. And then what about the situation where, and I think for the experts here who have worked with founding teams, what about, people where it's not clear cut, they don't operationally just step out, but they start to do less? How have you dealt with conflicts, and does it ever affect how you apportion equity and other comp?
I haven't had a founder leave. I've worked through situations where very early executive employees have moved on. And it's very difficult. It's messy. It's emotional. It is many, many hours of essentially like therapy with both coming to that decision and then crafting the communications, working through the package, then negotiating the package. The situation that I'm thinking about had a very unique equity situation, so we had to work through that. And yeah, it was awful. It was a divorce. I mean, when someone has been there since very early on, these things are horrific. No one expects that it's going to end that way. And my role was to mediate it and to get us in as best a position and best in outcome as we could, given the circumstances. And
I think Reed Hastings says it really well. Please go to Netflix career page. Phenomenal way they've written their culture deck again. Mediocre performance meets generous severance at Netflix. I follow that very clearly. You are up against just monstrous headwinds as a founder. And you're small, you're raising money, you got to get your product market fit, you got to get your customers love you, etc. And then if you have someone who's mediocre, and once you know what good looks like, I think it's very important. Most founders don't have a point of view on what good or great looks like. Mm-hmm. Right? Once you know what it looks like, and if this person is not meeting that standard, it is out. You cannot be kind of double clicking on this will change, et cetera, because you don't want someone to go from B- to B+. Mm-hmm. Right? To your point, you could have A- and there could be a lot of issues, and you could get the person to A+, and that's when you know the person is good but is not engaged or is not kind of throwing his or her weight. But if there's someone who's B-, you got to bring the hammer down on that right away. Generous severance, goodbye.
Even a co-founder?
I think co-founder is going to be hard. I mean, it is going to be hard. It's going to be messy. It's going to be hard. I think you've done all the right things of having all those documents early on, which is great. In many companies, you don't.
Yeah.
It is going to be messy if it's a co-founder. And then I think you want to, when you say goodbye to someone, you want it to be respectful and humane. At the same time, you got to understand that your allegiance is to your company, it's to your baby that you're kind of growing, you're kind of helping grow.
And just to double click on that, the part that's the hardest is like this person and their family and oh my goodness. And the question that I ask back is, what about all of the other employees and their families? And that's where, like, when you've got someone on the team who was an early employee who was great when you were 5, and was a wonderful contributor when you were 5 people, but now that you're 20 is floundering, and that happens. Most people at scale do not end up being able to scale. It's very rare that your first employees are still going to be at 150, at 250, still killing it, because it's just different DNA at different stages. Like it was crazy that I was with Meetup 10 years and at 45 was a great fit and at 200 was still a great fit. Like that's not usually how it goes. But I think that's the question that we have to ask ourselves is like, but what about the other people who I'm responsible for ensuring that their paychecks hit?
The one thing that comes up in a few panels here and there is the value of kind of outside just mental health counsel for the founders and the founder teams. They might not have Madan and Alana and Aaron, but there's like Reboot is a resource that you can look into. Jerry Colonna was a great counselor to many startup teams in New York before he moved out to Colorado to start Reboot. But that's something to definitely look into. And I can always recommend people in the community to do that. But talking through these conversations about how much equity people get, how that might change over the years is really important. I'd also put a personal plug in to consider always that this will end. The likelihood of everybody walking away in 5 to 10 years with $10+ million in their pocket and leaving the company, it's almost zero chance. Somebody will stay, someone will go, someone will, and knowing what these scenarios might be can be hugely beneficial. Founder teams, has anyone had the experience of someone asking for founder status versus just founder equity? How did that go, Aaron?
They did not receive it.
Okay. Madan, a question for you. Oh, how can we get these offer calculators? Is there a tool?
Sure.
Does anyone have?
Just send me an email. I'll send you mine, and we have a master template.
Okay.
I'll send that over to you. I'll of course take away my strike price and preferred, but you can add that to it, and it's very powerful.
Does anybody else have tools that they find particularly useful for managing equity and comp, like a Carta type tool? What do y'all use? Oh, okay, you do use Carta, Michael.
We use Card as well, and that's a 409A provider as well.
Okay.
So even if you're on there from the very, very, very early stages, even if it's just yourself and your co-founder, you can literally use that to manage everything.
Alana, you started talking about the importance of negotiating the 409A. I think that's something a lot of people don't know about, and this is getting a low 409A is so important. How do you advise people negotiate on that?
Just in case folks aren't clear, that 409A valuation is your strike price. It's what the outside company tells you the value of your company is. So it's really important. The lower that is, the more value you have in each and every share of your organization. So companies do try to push back on the different levers of 409A. It's generally not me, it's someone on the finance team. Do you guys have more experience on the 409A levers?
Have you done this, Michael?
No, that's why I said, my recommendation in the early days, like if, before you do a formal fundraise, for instance, the reason why we, wanted to do is because we raised via convertible notes. So we raised via convertible notes, all of our working capital, all of that stuff in the early days. So while you're doing that, you still aren't prescribing a value to your company, right? You're kind of like kicking the can down the road, and there are obviously benefits to that. But when you kick the can so far down the road that you have the investors prescribe that value, there's a lot of money, right, that you left on the table for your employees. Right, by not, getting that stamp of value in the early days when someone's going to tell you, well, this company is worth, $2, right? The strike price on those options are very, very, very low. But then if you get a VC coming in saying, okay, this company is worth $10 million, right? The 409A provider now has to take that into consideration.
Yeah.
Right? They have to be like, well, they just raised investment. This value is $10 million. Now they still go out and use market data in order to prescribe their own value to the company, which could be lower. But yeah, so that's why I always recommend, if you are planning to fundraise in the foreseeable future and you haven't done a 409A valuation, like it's, pretty advisable to do so just for your future employees.
One important topic, that's a great point. The first value your external party, your auditor would come and say, this is your 409A value. It's not the last. You can go back and say, this is too high. So do not just accept that this is the only number. So have a great, law firm that will give you this advice, and then go back and forth. And you're like, how did you make this? How did you arrive at this number? And then your auditor or whoever is doing that will have to justify that, because remember, your 409A value is the strike at which your share is being struck at. And so if it is $3 per share, that's the cost of each share. And then you can go back and forth, and sometimes it'll actually come down by 30-40%. And eventually that's the number, as far as I know, you declare it to the IRS. So it has to be really tight.
Yeah.
But there's a lot of back and forth. It's not exact science. The combination of art and science. I think, to Michael's point, the first question your auditor is going to ask is, well, you raised money at $6. And you're telling me that your true value of the company is $2.
Yeah.
But that's okay. You have to go back and forth, and with a good finance person, you'll be able to do that.
What about tying equity to goals, OKRs, KPIs? I mean, that is part of comp. It could be considered a bonus, a vehicle. How do you tie that together?
I really don't like it at all, because it just takes your focus away from running your company. Mm-hmm. So tie it to tenure, meaning that there is cliffs, and tie it to great performance that you're going to be focused on every 3 months, every 6 months. If people are not performing, then you can let the person go. Yeah. Because if you start tying it to goals, I'll start telling you that I coded this, but that team did not do it. The infra team sucks, or the India team did not give me this stuff, or the product manager was sleeping at the wheel, and I will start to really suck up your time.
Yeah.
Because this is now, you've tied it to a goal, and then instead of running your company and product and customers, you're now talking to a bunch of employees who are all unhappy. So tie it to a cliff, tie it to a vesting, and then do some basic talent management principles. Every 3 months, evaluate your employees, how they're doing, B-. Depending on your philosophy, have a philosophy to start with. And once you do that, then this should not be too much of an issue.
I want to try to hit these remaining questions. Remains a question, I guess. Do you see a difference between expressing equity in terms of percentage of equity, or shares and share value? What is are there implications of either?
I think it's really a stage question. In your earliest stage, people want to know what percentage of this company do I own? Mm-hmm. You've got 5 people or 10 people. They want to know how much they own in that way. At some point, that becomes very stale as you grow, and
because it's so low, and
right? You're like, oh, great,
point.
I have no idea what percentage of Lyft I own, but it's not going to be super exciting. So at some point, it just changes, and you start valuing by number of shares. And then over time, I think I noted often when companies are public, they then value by dollars.
Okay.
By actual value.
So
Yeah.
I'll add to that just because in early stages, like she said, it's very relevant when you're hiring that first employee or that co-founder, like how much of this company do I own? So they are going to want to get some percentage, but it's all about communication and transparency and just clarity. It's like, listen, this is what it is right this second. This may change over time. And that's why it's not a good practice to continue doing that. For multiple reasons. It gets very, very, very complicated. But definitely in the earlier stage, you might want to just have a higher sensitivity to that.
Yeah, once you start raising money, dilution happens, and the more focused you are on percentages, the more heartburn people start having, and then they want regrants because they still want that 2%, and you don't want to be stuck in this vicious cycle of having to make people whole or having to unpack for them like, no, because we raised more money, your equity is actually worth much more. And I've had to do that for folks, and it's an exhausting conversation. So I'm someone who, when I get an equity grant, I immediately do the math because I want to know, just like for my own knowledge, what my percentage is. But I also have the understanding that that is only for this period of time, what that percentage is. I have like a deep understanding of how equity works. Most of your employees are not, unless they're your very early stage folks who are veterans.
And how might you educate the people who are joining the team, like the people who ask questions? You can't answer all of them. Do you refer them to something?
We have a one pager that we'll give to folks. If they're asking about percentages, I'll be very honest. We don't communicate in that way. We haven't since I've been there. We have the calculator. I'll explain to them why we don't communicate in that way. I'll explain to them, when you raise money, how dilution happens, that's an okay thing because that means the company is growing. When you raise money, that's your ticket to continue to exist, and unpack it from that percentage. With junior folks, especially, our recruiters will sit down with them and kind of walk them through what equity is. Sometimes there's a misunderstanding that equity means I own part of the company now, as opposed to the option to purchase later, that actually you don't have anything for your first year. You don't have access to anything for your first year. We have a 1-year cliff. So we walk them through it so that they have, we feel it's our responsibility, especially for folks where this is their first rodeo, to ensure that they have as deep an understanding as is appropriate.
Yeah.
Because a lot of startups just don't have the manpower to be able to do that.
I want to thank the panelists so much for sharing this. I know these can be these are touchy topics, and Michael especially, thank you for being so candid.